Welcome to the Bull Strangle Strategy. Our approach combines stock ownership with systematic option selling to generate income while maintaining long-term market exposure. Every trade follows a repeatable process built around stock selection, premium collection, risk management, and disciplined execution. Let's get started. If you've ever sold options, you've probably noticed something interesting. Right before a company reports earnings, option premiums often become much larger. At first glance, that seems like a great opportunity. Higher premiums should mean higher profits, right? Surprisingly, historical research suggests otherwise. Today, we're going to look at why one of the most important filters in my entire stock selection process is simply avoiding companies that report earnings during the holding period. Most stock price movement happens gradually. Earnings announcements are different. A company can report profits and still fall because expectations were even higher. Another company can miss earnings estimates and rally because investors expected even worse results. Once earnings are released, normal market behavior no longer applies. One overnight gap can erase weeks of collected option premium. That's a risk no option seller can control. Rather than relying on opinions, I wanted to see what history actually says. I compared stocks that reported earnings during the holding period with those that did not. The difference was significant. Stocks without earnings produced higher average returns. They had higher win rates, and perhaps most importantly, they experienced few larger losses. Meanwhile, stocks that reported earnings generated low returns while suffering substantially more large drawdowns. The data made the decision surprisingly simple. Could you occasionally make a great earnings trade? Absolutely. Some earnings trades produce exceptional returns, but this strategy isn't designed to hit home runs. It's designed to build a consistent results over hundreds of trades. Avoiding earnings doesn't guarantee success. It simply removes one of the largest sources of unpredictable risk before a trade is ever placed. That's exactly what a disciplined process should do. The earnings filter isn't a standalone strategy. It's one step within a larger framework. First, we screen for liquidity, then we eliminate earnings. Next comes the 7-metric ranking system. Finally, sector diversification helps build a balanced watch list. Each filter improves the odds just a little. Together, they create a much stronger portfolio foundation. At this point, we've identified a diversified list of high-quality stocks that have passed every screening filter. Now comes the next question. Which options should we actually sell? In the next video, we'll discuss how to evaluate option liquidity, open interest, bid-ask spreads, and contract selection to ensure that the best stock also becomes the best trade. Before you go, continue your Bull Strangle journey. Visit bullstrangle.com to receive weekly stock selections, option selling opportunities, and ongoing research designed to help investors generate consistent income. For a complete step-by-step guide, pick up a copy of the Bull Strangle Strategy, which is available on Amazon. Research, discipline, consistency, income. Thanks for watching, and we'll see you next time.